Hello and welcome. You're watching the Global Reset from the CNBC TV18 Prime Ionic Wealth Angel One Studios. I'm Prashant Nair. Well, lots happening, both global and local. But just first, a quick read-through of the global equity markets. Major U.S. indices, along with the small-cap Russell 2000 index, posted pretty large losses on Thursday, that is last night, to close out their worst one-day performance since October 10th. The Dow average lost about 800 points at 1.7%, taking back gains seen in Wednesday's session when it crossed the 48,000 levels. Stocks across Asia Pacific are mirroring the cuts that Wall Street has seen. The technology rout has deepened, and hopes around a rate cut from the Federal Reserve seem to be fading. Remember, the big concern, especially with regards to technology and technology stocks, the large technology stocks in the US, of course, is valuation related, whether there is overinvestment in the artificial intelligence theme. And occasionally, last few weeks, we've been seeing some pullbacks along the way. Last night, for example, the poster boy of the AI trade, NVIDIA, ended about 4% lower. Now, back home, it's a choppy day so far on Dalal Street. Nifty hovering sub 25,900 levels as well. The big story here in India, of course, remains the Bihar elections, right? And that's essentially what we're shifting focus to. The Bihar election outcome is underway. Counting of votes is underway, but the National Democratic Alliance, or the NDA, is leading comfortably. I think the last we checked, 50% of the in 50% of the seats, I think about 4 or 5 rounds of polling have been completed. The NDA, as you can see, is leading with about 190 seats. And if those numbers hold, it's going to be a sweep, a massive, impressive performance by the NDA, which, of course, has the BJP and the JDU and other parties in it. The Bharatiya Janata Party, by the way, the BJP is also seen to be crossing the 50-seat mark, leading in 84 seats. RJD's Tejaswi Yadav, the chief ministerial candidate of the MGB, is leading in Raghopur. Polling results for polling in all 243 assembly seats will decide whether the Janata Dal United Chief Minister Nitish Kumar, the state's longest-serving CM, will secure a 5th consecutive term, or whether, which is looking very unlikely, there will be a change or a shakeout at this point in time. So that's a big political story which we're tracking here, of course, in terms of local politics. But we're going to, stay with global markets, right? I mean, because that's the big question. Are global markets, after the huge outperformance that has been led by technology, AI in the US, is that under a bit of a cloud? Are there question marks around it? Let's welcome in our guest on the program, Bhanu Baweja. He's the chief economic strategist at UBS. Bhanu's here down for the UBS India conference. Bhanu, great to have you on the program. Thanks very much. The biggest question, I guess, on everyone's minds, Bhanu, is this. Is the big AI theme in a bit of a bubble now? What's your view at this juncture and as we head into the new year 2026? Go on.
Got to be a little careful about this because, even normalizing for usual sell-side optimism, I would have to agree that this is not a bubble, right? Because again, let's try and be specific about definitions, like what is a bubble or what constituted a bubble in the past. If you look at the past 50 years, again, I don't want to go back to the 1600s with the tulip bubble and so on, but if you just look at sort of recent economic history, last 50 years, there was the Nifty 50 bubble in the early 1970s, there was the Japan bubble in the late 1980s, and then, of course, the one that we remember the most, which is the NASDAQ bubble of 1999-2000. After each of these, the relevant sector or the market as a whole corrected something between 50 to 80%, right? That's what a bubble is. We're not just talking about the market being expensive in a bubble, which I think nobody will disagree that the market is expensive, that expectations of earnings are very high, and that valuations that we're putting on those earnings, the multiples that we're putting on them are very high. So you could definitely get a correction. But a bubble is a different thing, right? A bubble is when the NASDAQ corrected 80% between 2000 and 2003. I don't think we have the ingredients for that because the micro of these companies in terms of free cash flow, in terms of margins, in terms of sales, is just orders of magnitudes better than it was in the 1990s. So from that perspective, it's not a bubble. Now, the minute I say it's not a bubble, I don't want you to think that, oh, that must mean that it is a bullish view on the market for the next 3 years or 4 years. The point is that a bubble could be a sufficient condition for a major market correction. It's not a necessary condition. The market can consolidate, and we think the S&P 500, for instance, over the next 3 to 6 months will consolidate despite this not being a bubble, right? So I personally think that most of the comparisons with the 1990s are at best contrived, if not fully wrong, because the micro is so much better and the macro is so much worse, but it's not a bubble now.
I think that's a good sort of description, a starting point. Now, Bhanu, when you say micros, right, are so much better, do you mean, for example, the earnings season has been great? I'm talking about corporate America posting, I think some of the best broad-based results since 2021. Is that what you mean?
I mean, the earnings season is great, and I mean that these earnings don't seem unsustainable because these earnings are not based on Capex that seems completely useless, or the Capex is not driven by debt, which will not be repaid. Most of the companies the companies that are being valued quite highly have very strong free cash flow, have had a steady earnings stream, have had a steady ability to boast very high net margins. Are we getting ahead of ourselves? Sure, we're getting ahead of ourselves. I think valuations are expensive. I think earnings expectations are far too high. That's why we think the market will consolidate. But again, to go back to your first question, if I say this is a bubble, I must expect market cap to halve in the next couple of years. I do not believe that that is going to be the case.
Oh, yeah, absolutely. Well, the other one, of course, what we want to touch upon, Bhanu, is, let me actually prod you some more on this, right? I'm not referring to stock valuations here, though. Are we sort of too ahead of ourselves, so much so that it could lead to misallocation of funds? So not, whether something is trading at 30 times or 40 times and whether that is maybe too high, but, is allocation, capital allocation, which some of these large technology companies are making, could that lead to capital allocation mistakes?
Yeah, no, that's a relevant question. I think the possibility of, excessive capex is a very real one. I think, most of these companies, the way they're conducting the capex right now, it does feel like a little bit of build it and they will come, right? So it's more supply creates its own demand kind of thinking. And there's no doubt in my mind that there will be disappointments along the way. So I happen to think that AI as a technology will be much more consequential than the telecoms of the 1990s, except I think it will also take much longer to come to fruition. And what is fruition? I mean, what do we mean? When can we say that AI has come to fruition? When basically this doesn't remain a tech story, but non-tech sectors, real life sectors, finance, insurance, retail, commercial and professional services, healthcare, that companies in these sectors begin to tell you that their revenues are being picked up or their costs are being slashed directly as a result of AI, right? Are we there yet? Absolutely not. UBS is a big equity house. We have a lot of equity analysts out there. And when I go and speak to our analysts, particularly in these sectors, okay, and I say these sectors because which are the kind of industries that AI will move the needle for first? Very data heavy and very labor heavy, because data heavy industries are ones where AI can harness that data to give you better outcomes. Labor heavy, where you can actually bring down your costs, potentially replace that labor or upgrade that labor in order to increase margins. So you want to be watching sales per employee of these kinds of companies, the kind of sectors I spoke about. And I'll say that once again: commercial and professional services, asset managers, insurance, banks, and also retail. So some of these companies are the ones where should move the needle first for AI. I don't see that happening right away. I do have the faith that will happen. I mean, we can't wait for the macro productivity data to improve. I think we're going to be waiting many years if we keep waiting for that. I think if you have to see where is AI having an impact on a micro level, these are the companies that I will be watching. And there's no doubt in my mind that there will be speed bumps along the way, right? When I say speed bumps along the way, I mean investors' expectations will run ahead of reality, and there will be negative surprises where capex is high, but suddenly orders drop, sales drop. And that's when the market will get jittery and impatient. And that's when you can get corrections in the market. And you will be right to say that the AI theme is being overhyped. But again, my only point was that I take exception to the word bubble, because that entails completely debt-driven, useless capex, which is not the kind of capex that we have been seeing. In fact, if you look at the growth of software capex or intellectual property capex more broadly, including research and development, the CAGR of that capex is roughly half of what it was in the 1990s. So if you compare to the 1990s, again, I don't think the comparison is perfect, but if you did, you'd find that we're still in the early stages of the capex boom.
Okay, got that. And I think you're acknowledging that the risks remain. There will be mistakes along the way, but I mean, the theme is real, and it's going to last perhaps for many years. Now, Bhanu, you said that the S&P will consolidate. You briefly said, right, over the next 3 to 6 months. Could you put out your view and targets, not just for the US, but across regions that you cover, and throw in India there as well?
If you take a 12-month view, we expect the S&P will get about 7,500, but basically most of that action comes from the second quarter, more likely the second half of next year, because what lies directly ahead of us for the S&P, we think, is a US economy where the growth inflation mix is likely to worsen. So this is where we pay the piper for the tariffs that have been in place for a while, which really was supposed to be the big theme of the year, really did not turn out to be the big theme at all, completely irrelevant for the market so far. But now we think in the coming 3 to 6 months, tariff-led inflation is going to go higher, and the consumer is going to start feeling the pinch of lower disposable incomes. And that's going to mean that profitability of S&P companies, particularly consumer companies, but also more broadly, are going to come down or are going to be revised down, which is why we see the market consolidating to small down over the next 3 to 6 months. But beyond that, as tariff inflation comes down, you begin to see the market picking up again and head towards 7,500. That's the S&P view. Now, what helped emerging markets this year was belief in a weaker dollar, and you got a lot of flows into emerging markets. Unfortunately, India wasn't one of them. India saw pretty flat returns, but overall in emerging markets, we saw pretty decent returns. And we do not believe that we will get a year of very strong inflows into EM now, because we think the dollar is going to be flat. Unlike 2025, where we called for a weaker dollar, we're calling for a very flat dollar. So the dollar holding its ground into 2026. And that's going to be a year where emerging markets perform reasonably well, but probably underperform the US. We are long-term India bulls. It's hard not to be in a world where you're growth starved. But here and now, given where India's nominal GDP growth is, which is at the lower end of the last 2 or 3 decades, given where the US's relationship with India is, which we don't think is permanent, but given where we are, we think India is probably going to underperform within the emerging markets context. So US outperforms EM, EM likely outperforms India, as it has done this year. One of the investment ideas that we like is a long China position. We think India does well in absolute terms, but probably doesn't do as well as some of the other markets like China or like the US.
Well, I think more underperformance, Bhanu, is what you are sort of saying India will see. But you like the story long term, of course. We'll take a quick commercial break here. Bhanu stays with us, and we'll continue some of this discussion. And we'll ask him about Trump and Trump's policies as well, whether there will be any change post some of the recent electoral setbacks. Stay tuned, coming up on the other side. Welcome back to CNBC TV18 Prime. You're watching the Global Reset. We're in conversation, of course, with Bhanu Baweja of UBS, and we'll be talking about whether we are in a bit of a bubble as far as AI as a theme is concerned, and what he feels India and other markets are going to do in 2026. Bhanu's view, of course, is that India is going to relatively underperform. Bhanu, I mean, for viewers here, it's going to be a bit of a sobering kind of assessment. So it's US, EMs, and then India. That is your kind of pecking order as we head into 2026. My question is, do you think some of this is because of the lack of AI plays in India? How much of a reason is that? Because I've heard that from many large investors.
It is a factor, but that didn't stop Europe from outperforming last year in dollar terms. You see, Europe doesn't have many AI plays, and yet Europe did quite well. There's no doubt that markets like Korea and Taiwan, which, companies like TSMC and Samsung and Hynix, they are very much a part of the value chain, supplying the AI trade, supplying the AI Capex trade, and that's why they have held up in better stead. So that's definitely an issue, but I think it would be too narrow a lens to look at the markets from if we said, is that the only thing that's deciding performance? Europe did reasonably well, despite the fact that for the third year running, European earnings growth was zero, right? And despite that, you saw enough flows and enough differentiation within the market that the overall index actually did quite well. So that is a factor. I don't think that's the whole story for India.
No, point taken. So one of the factors is lack of AI plays, but of course, I mean, there are other maybe more significant factors as well. So you're saying that, as I said, the pecking order is US, EMs, and India. So one more year of underperformance, relative underperformance, Bhanu, right?
Yeah, although absolute returns, I think, should be okay, but we think it's not yet time. We don't have the catalysts. Much as we are long-term bulls, we don't have the catalyst yet to turn super bullish on Indian equities just right now.
Okay, got that. Let's talk about themes, Bhanu, right? I mean, you have a global perspective. Any interesting themes which are playing out globally? One, of course, is AI, but anything else which you think will replicate itself in, some shape or form here in India and should be on the watch list for investors?
No, I think one of the key questions we really have to answer is one point that we already have discussed, which is what is AI's ability to diffuse from the tech sector to the non-tech sector? Because the minute it begins to diffuse to the non-tech sector, the nature of the market completely changes. It doesn't become anymore an AI trade. It doesn't remain anymore an AI producer's trade. It becomes a trade of who's consuming AI most efficiently. And that's where small caps could do well. That's where the value trade could do quite well. That's where low quality companies could also do quite well because their profitability is enhanced because of AI. And in that case, consumers of AI, which could be Europe, which could be India, could also do quite well. So I think we've discussed the most important question for global markets, not just the US market or Europe or India or anyone in particular, but I think the single most important question for 2026 is whether non-tech companies can begin showing improvement in monetizable profitability in terms of AI through higher revenues or lower COGS directly because of AI. I think that's the single most important question for next year. We see that as glass half full, but we really have to, as investors, we're going to have to be really nimble to see whether or not that actually comes to fruition. Because if there are disappointments there, then I suspect that the overall markets will also be correcting. The other question, I think, which is going to be quite important, the other theme which is going to be quite important is because many emerging markets, including India, this time do not suffer the same inflation as the developed world. In fact, historically, EM has been the one, India included, that has suffered significant inflation, whereas developed markets have usually been in a world where the cost of equity could be quite low because of disinflation. I think in this case, the question is entirely the reverse. US has high inflation, China serious disinflation, India somewhere in the middle, but probably more close to disinflation. How much can monetary policy help boost growth, boost credit growth, and thereby lift overall economic profile and also the EPS profile? I think that'll be quite important. We think the RBI is more or less done. We probably get 25 basis points more, but let's see if there's more room. We're wrong, and in fact, there's more room for the central bank to cut across emerging markets, RBI in particular in India, and that leading to a credit cycle, that leading to a domestic demand cycle in places like India. Because the one thing we have sorely missed, and we've sorely needed, but unfortunately not had, is a private sector Capex cycle in India. Hopes of strong profitability into the future, hopes of strong productivity into the future. So not just the government spending into Capex, but as the government is now trying to consolidate and bring down its fiscal deficits, that the private sector steps up. Thus far, the evidence is quite mixed, but if we do get monetary policy support and decent credit growth, and hopefully continue with the tailwinds of low inflation and very strong agricultural produce, I think that can lead to a pickup and uptake of credit such that the investment cycle also picks up. So I think that theme is going to be very important for both the Indian markets and for the Indian economy as well.
Got that, Bhanu. You know, the last question from my side on this one, Bhanu, two questions actually, both related to Trump. One is Trump in India. The first is whether we will get a fair and good trade deal and how soon. And second, do you think with about a year of Trump administration behind, there will be any changes, dilution to the America First industrial policy, broad policy thrust, or you think we will see more of the same?
I think the answers to both these questions are no and no, and that I'll answer the second one first. I don't expect a dramatic change in policy from the Trump administration because I think they like the tariff revenue. I think they're enjoying the fact that fiscal is improving as a result of their tariffs. They philosophically believe in them. They always have believed in them. And I frankly think they would have gone much harder had it not been the bond market rebelling in April, which is when they backtracked. So as long as the levers of pain are not pressed, as long as the threshold of pain is not crossed, and I would measure that pain not in terms of S&P losses. I'm not saying they're completely agnostic to S&P, but I am saying that they care about the bond market. Scott Bessent cares about the bond market much more than they care about the equity market, because the bond market is a sufficient condition. If you get bond market pain, then you definitely get the equity market pain as well. So if the bond market rebels, then they pay attention. It hasn't been rebelling. They have been getting revenues. So I suspect that this administration's, this White House's protectionist policies will continue, right? So that's the second part. The first part is how they directly deal with India. I'm afraid I think the news could remain worse, potentially even get worse before it gets better. But I do have faith that the news will get better because, frankly, over the medium term, which is anything more than 6 months, there is just too much commonality in terms of political thinking and then also in terms of economic interest for even this White House, let alone a new administration, for even this White House to continue a policy of pressing India. I mean, again, their big issues have been Russian oil, and as we know, not in a steady decline, but over time, if you average the trajectory of India's intake of Russian oil in the last year, it has been coming down. So I think Donald Trump's taking account of that. The big question is going to be what kind of tariffs we get on services as well, which is why I think there's a possibility that you get a little bit worsening of the news before it gets better. But if I'm a tactical investor, I would be a little cautious, and that also feeds into, as I said to you earlier, India underperforming emerging markets over the next few quarters, maybe a couple of quarters. But if I'm a structural investor, I really do not think that this is a theme that we need to run with. I think India's locus standi with the White House is such over the medium term that these are not going to be issues that will impact the NPV of companies in a big way over the medium term.
It's really a great conversation, Bhanu, and I think we covered so much ground on this one. Appreciate it very much here on CNBC TV18 Prime, and look forward to more conversations in the future. Thanks very much. Okay, I think it's a wrap on this edition of the Global Reset. You've been watching the program here on CNBC TV18 Prime. More global programming coming up after a quick commercial break. Stay tuned.